Hey, welcome to the Interledger Salon. Today you're listening to the third iteration of the Interledger Salon, a quarterly panel presented by the Interledger Foundation. Our goal with these curated discussions is to host some of the most exciting people in our ecosystem, who, like us, work with energy and passion to build a more equitable financial world. This will be a space for conversation, sharing, and organizing together. And today's conversation will be facilitated by Smriti Parshera, a research ambassador at the Interledger Foundation. She will convene with Susan Thomas, co-founder of XKDR Forum, and James Odaga, engagement director at the Busara Center in Kenya.
Hello, everyone. My name is Smriti Parshera. I'm a lawyer and a technology policy researcher based in India. And today it is my pleasure to be hosting the Interledger Salon. I'm currently a research ambassador with the Interledger Foundation, where my project focuses on understanding the lived realities of digital and financial access in my home district of Lahaul Spiti in the Indian Himalayas. In keeping with that spirit of untangling what financial inclusion means for different communities across the global south, today, I'm excited to be joined by two guests who have thought deeply about this subject in the course of their work. Our first guest, James Ogata, is based in Kenya, and he is the engagement director at the Busara Center. Busara's work focuses on leveraging behavioral sciences to gain deeper insights into people's financial lives and creating suitable solutions for them. In this process, James collaborates with institutions in the private sector, philanthropic organizations, and government agencies to design inclusive financial products and markets. Welcome to the session, James. Our next speaker, Dr. Susan Thomas, is an economist from India whose research spans across the areas of finance, markets, and the economy. She is the co-founder of XKDR Forum, a group that has been doing some cutting-edge quantitative and policy-oriented research in a variety of areas, which includes studying how households interface with the financial system. Susan has worn a number of academic and policy hats, which includes her instrumental role in shaping India's insolvency and bankruptcy regime. A warm welcome to you too, Susan.
Thank you. Good to be here.
Thank you both for taking the time to be a part of this conversation. And let me begin by asking each of you to tell us a little more about the work you do at XKDR and Busara, respectively, whether it's in the context of financial inclusion or the work you do beyond that. And if I may add, it would be interesting to know a little bit more about the meaning and the origin of those very interesting organizational names that both XKDR and Busara have. So maybe starting with you, Susan.
Thank you, Smriti. Yeah, this is a question that we get often. XKDR is a compilation of letters, and I think it's easy to start with explaining what the K, D, and R stand for. It's knowledge, data, and research, which we think are instrumental in beginning to understand a problem, a social problem, an economic problem, and to diagnose it and to come up with a policy solution for it. The X is the most important part of that name because a long while ago, we realized that any single discipline, i.e., economists, by themselves can't come through this entire chain of work. So X stands for cross-disciplinary. So that is, we use knowledge, data, and research from multiple domains to come up with a diagnosis of social and economic problems, the big questions of our age, and how should we think about coming up with ways to solve for that. I hope that makes it clear. And before I let that go, XKDR is XKDR Forum. That's our full name. And Forum stands for the recognition that we are a small organization and we believe in doing our work by building collaborations with other organizations who are like-minded and focus on similar things. I hope that made sense.
Perfect. It makes perfect sense. And I think a lot of the conversation today is about bringing out this interdisciplinary nature of the conversation. Over to you, James, on that. Tell us a little bit more about Busara and the name and what you do.
Thank you for that question, Smriti, and for having me as well. So, Busara is a Swahili word that essentially means wisdom. And the full name of our organization is the Busara Center for Behavioral Economics. And Busara started as a small office with a postdoctoral researcher studying the psychology of poverty and using a behavioral science to see what kind of policy advice that can be given to different practitioners. And after some time, it eventually evolved to practice. And so today, Busara applies and advances behavioral science in pursuit of poverty alleviation. And we apply this trade in spaces including education, civic engagement, health, But my team and I work with the private sector, policymakers, and philanthropy to figure out how to make financial markets more inclusive and value adding to people in low income contexts. So, very happy to be here and excited to have this conversation. Thank you.
Thank you so much, James. So, to begin with this question of just getting our roots into what is financial inclusion and what does that mean to each of us, given the different perspectives we all bring to the table. And we've seen over the last few decades, there's so much focus, specifically in the policy circles, about furthering financial inclusion, but really the term can mean different things. So, let me ask you, James, to begin with, what is your interpretation of what financial inclusion means and why does it matter?
So, to me, essentially, what it means is a recognition of the inequalities that exist within these societies in the global south. And I think before I even start is to acknowledge that there's a lot of differences when you look at different markets, even within Sub-Saharan Africa, for example, around usage matrix, the accessibility of some of these services. So I think about these socioeconomic conditions create a landscape that demands different kinds of innovations and context-specific solutions. So whatever solutions that we have seen emerge in some markets, avoiding an assumption that they're going to work in others. And I think this is at the crux of the financial inclusion industry, is an acknowledgement of the diversity of challenges and opportunities that exist in different markets. But also when we talk about financial inclusion, we also think about regulation and policy at large. So we see both barriers and opportunities related to regulation in the context that some markets have greater risk than others. But then we also see the need for different kinds of policy initiatives in the different markets that in the global south. And in some cases, there's a role for policy to play in allowing for innovation and responsible versions of finance to flourish. And in other markets, we see the need for policy action to protect customers from emerging risks that are emerging from digital and more traditional means of finance.
Thank you. Yeah. Susan, do you want to come in on that? Your view on what is financial inclusion and really who do you think are the key stakeholders, in this financial inclusion puzzle?
I think that is a very important question because I think, as James just pointed out, the phrase financial inclusion has been used as if it's a bucket that is supposed to mean the same thing but means something very different across the board. I think of financial inclusion as addressing a sophisticated layer on top of a very fundamental social phenomenon, which is that households and human beings tend to save. And when they save, the question is, what are the choices that they have? So to me, when I think about financial inclusion, and this might run a little counter to the standard thinking in financial inclusion, which is how do we increase access to credit? I think of how do we increase access to all forms of financial instruments and products so that people who are able to save can do their savings better. So it's not just about having a bank account. It's not just about being able to access credit, which in a certain sense is slightly different from what we think of as savings, right? Savings is what you set aside from what you earn today, and you hope to be able to support your requirements and your needs in the future. And the question is, if you are able to save, how is it that you're able to save so that your future self can get more than what she would if she were just keeping the savings, say, under her mattress, which is what probably our grandparents' generation used to do. So today we have so many more instruments like fixed deposits, we have insurance, we have pensions, we have mutual funds. Each of these are different ways in which people can access better returns to their savings in the future. And the question that I think that is an important one to ask, particularly for us in the global south, is that given that we're starting with a base that is really low, how is it that we can help people to be able to accumulate to a better life faster just because they've got access to better ways of gaining returns out of savings? And as I said, a lot of the times people think about this as, do you have access to payments? Do you have access to credit? But I think that that's a very limited way of thinking about financial inclusion, which shows up when we think about the way people used to think about financial inclusion before the 2008 credit crisis, or indeed the latest COVID crisis, when so many people lost their jobs and suddenly had to give up on their houses and their ideas of how much they could consume on a day-to-day basis or a month-to-month basis. And that is when so much more focus came on saying, look, it's for everybody. But when we think in the global south and we consider that we are thinking about people who are disadvantaged in so many ways, it becomes an especially important problem that we need to think about and solve better.
I think it's interesting. I mean, we've framed this conversation around, untangling financial inclusion in the global south. And in both your comments, it really came out that there is something different about the global south perspective and this context. And I was wondering if we can go a little bit more. Some of you brought about some of those points that there is a historical disadvantage context which is here. But is there something different, broader than that, like beyond social economic conditions? Beyond historical factors, is there something about regulatory capacity? Is there something about innovation potential or capabilities? Is there something different from the supply side as well in the global south context?
So I think that the big learning about what is different from the global south is, people tend to look at developed markets, developed economies, and say, look, the business models are working there. Why don't we just transplant those business models into every place in the world? And because those countries are rich, then it will benefit the developed markets or the emerging markets as well. I think that there is a big problem there because what drives financial services and products in most of the richer or the more developed economies is that financial service providers are used to thinking about their business giving them or supporting a certain amount of return and revenue because those customers are higher income customers. That is not true. That's not the assumption that we can make about customers or the citizens of the global south. They are much poorer. So when you take the same business models that are playing out in the global north and you try to transplant them into the global south, the very same business models just won't work because the incomes of the people that they're trying to serve will not support it. So in a certain way, it's odd, but the need for innovation is so much higher in the global south because what is taken for granted in terms of what are the kind of business models of the global north just cannot make it in the global south because you cannot do that, which is why I think the banks and in India, and I know this space the best, so I will use examples from them. For the longest time, even for giving access to credit or giving access to savings account, it was not the banks that did the first push, not universally. Right? There were places where this worked because the state supported the effort of the banks to reach out to the last mile customers. But it was a very small coverage that we were able to achieve. Then there was the innovation of the microfinance business model that came in and made that last mile connect between the existing formal financial systems and the last mile connect. And I suspect that's what we are beginning to see. And this is not a beginning to see, this is the last 10 to 15 or even 20 years of the fintech revolution, where technology has come in to reduce the barriers of the cost of delivering old traditional financial services and products to the last mile customer. We're seeing that increasingly now in the space of payments, in the space of credit. What we are not seeing so much is how much of that can be delivered. The same channels can be used to deliver pure savings, long term savings, and conditional instruments like coverage for insurance or pensions. Right? That's not something that we are seeing too much. And I think that that's where we still need to have the innovation, that how do the existing firms or new firms come up to be able to look at this different customer base and start developing new business models to deliver what we think of as the old financial functions or products to these last mile customers. And from that point of view, Smriti, I do think that you make a very interesting link here, that just as we are thinking of taking the same business models for finance, we're also taking the same regulatory frameworks that we are seeing in the global north and transplanting them those here. But that's not going to work as well because it's a very different problem that that regulation is seeking to solve.
Thank you. Thanks so much, Susan. And James, can I rope you in there because you made a comment in your opening remarks about how very often people think of the African context as one context, but there is so much diversity within that context, and that of course extrapolated to the global south shows that there's so much more diversity within what is the global majority. So many countries, so many perspectives coming in that. So, what would you think is unique about the global south perspective? Is there a global south perspective? Is there an African perspective? perspective, or does it necessarily boil down to being much more national or community level in terms of the financial inclusion agenda?
It is, Miti. And I think to answer your question, I'll piggyback off some of the points that have been mentioned by Susan, especially around the role of innovation. And in particular, what we've been seeing is some momentum that people are shifting away from this idea that you can apply a global north business model to the global south. And we're starting to see much more localized innovation happening within the maybe sub-regions, for example, in East Africa, and you're seeing innovation happening like in West Africa for new different kinds of financial products. And I think what's behind that is that constraints often drive creativity. And the markets and the people within them and the innovators are thinking about solutions that work for their local communities and work for their different geographies. And what we've been seeing, especially in the last decade or so, is that the global south has become a hub for very frugal innovations. And we're seeing some solutions that are emerging out of necessity in terms of how can we better serve these local communities and how can these organizations work with each other to create a better enabling environment for responsible versions of finance to flourish. And maybe I can give an example. So think about East Africa, the East African context that I know fairly well, and in particular Kenya, an innovation like M-Pesa, which enables payment. And this emerged out of necessity because obviously the predecessor was cash and it was working fine. But then out of necessity to figure out how to do urban rural remittances, for example, that emerged, and it's something that people picked up fairly quickly. But on top of that innovation, we're seeing, again, out of necessity, the emergence of platforms for trade, for example. And these take care of logistics and they help small enterprises acquire business inputs at better rates. And they help the same micro entrepreneurs get access to different customers in online spaces, including the meta spaces. On top of that, again, we think about the role of emerging models of finance for enabling access to energy. And so we're looking at the application of pay-as-you-go models or pay-go, which is essentially a mode of finance to enable people to get off-grid energy solutions. And we're thinking about that. How can this model of finance be enable people to participate in the green economy and participate in a just transition? And because some of these off-grid solar energy, be it a solar water pump, these are really expensive products, but we're seeing an emerging role of finance in enabling that just transition. And so these innovations, they often have a wider global application, but they stem from specific regional needs. They stem from particular regional challenges. And in particular, the fact that they come from local innovators and they help address local needs, they are better suited to adapt to local cultural context. And I think that's why we're starting to see a changing momentum for locally driven innovation. So yeah, I think that's how I would summarize what I think about that.
Thank you. Thanks so much, James. Coming back to you, Susan, I know you've been doing some really interesting work on, bringing thinking around how do you measure financial inclusion, among other things, to identify what are the gaps in the way existing services and products are being provided. Can you just walk us through those ideas and, what you've been calling the input, output, outcome framework for measuring financial inclusion?
So I think that this is something that happens when you start thinking about policy interventions, right? And I think the fact that there are so many interpretations of financial inclusion exists all across the globe because we haven't yet bothered doing this. For any policy intervention, it is great to have clarity at the start of what is the objective. What is it that we choose to do is very clear, but what is it that we will get out of it? What is the objective? Is what is the problem? This is where we come to saying that all policy interventions must be viewed through the lens of the input, that is, what is it that we will do? What is the output, which is what is it that we expect to see that to happen immediately by way of actions or changes on the ground? But ultimately, this is not what we seek to achieve by in terms of the objective of the policy intervention. We need to see some fundamental change that happens in the lives of people, which is what we call the outcome. I often like to use the example of education because I think it's core to all of us, and we feel sympathy and we feel instant recognition in the space of education. So I'm gonna use that as an analogy to explain what I mean by input, output, and outcome as a framework for analyzing policy intervention. So in education, we all know that the government spends a lot of funds in promoting primary education or secondary education, and the programs usually target building schools and hiring teachers. This is what we would call the input, the amount of money or the number of schools and teachers that are hired. That's the input part, but that's not the end of the story. What we would like to see is that once these are built, children will come to those schools, and that's what we call the output. But truly, what is the outcome that we desire? That it's not just that children come to school and apparently pass some exams, but for the children that come to school and pass the exams, are they literate? Are they numerate? Are they able to pick up a newspaper and read it, or go through the internet and read something new and understand it? That is what we call the outcome. Now, if I apply this lens to the field of financial inclusion, the stated objective was to get people access to the instruments of finance or the services of finance. But that's not the outcome. And that is where everybody gets a little stuck. So we can think about applying inputs, outputs, and outcomes to financial inclusion by saying what we would like to get to see is spend money so that people get access to using finance. So they get access to credit cards, or they get access to bank accounts, or they get access to pension systems. And this is something that over the last 20, 25 years in India, we have seen the government putting a lot of effort into building the frameworks of input. But what is the output? And this is where my friend and colleague Soyash Rai from Carnegie often points out that India is very good on doing the inputs part of financial inclusion. But when we think about the outputs, that is, how much do people use it? When you have a bank account, is it something that you're constantly putting more money into? Is it something that you use to build your savings and to use to withdraw your funds to use for all kinds of activities that you want? India scores very poorly on the World Bank Global Financial Index on the outputs compared to lots of other countries that don't score too well on the input. And for us who sit in the policy space, we know that that's only halfway there. And the question that we need to ask ourselves is, just because we put so much effort into building financial inclusion and getting access to all our citizens to bank accounts, insurance products, are they better off as compared with those people that do not have this similar access to finance? And when we pin that down, the measurement that we seek to do is to talk to people and say, look, because you have a bank account, are you able to build savings better? But that's not the outcome either. It is because you have a bank account, you're able to build savings, and so that when you hit a rainy day, or when there's a crisis like you lose your job, or there is a health crisis in the family, do you have sufficient resilience to be able to withstand that without going into a complete meltdown mode where you have to stop eating or take away children from attending schools because you can't pay fees? And that's what we think about as the outcome of financial inclusion, which is that once you have people who are able to use finance intelligently and optimally, they should be more resilient in facing shocks and adverse conditions as compared with those people who do not. And this is what we put together as an input, output, outcome framework for financial inclusion. Now, I don't pretend that this is something that we can immediately roll out. I think part of the reason why, when we look around the world, it is so much easier to find financial inclusion input scores, like how many bank accounts, how many people have bank accounts, how many people have insurance. This is easy to do. But to find out how many of these people feel a lot more confident about what it is that their future looks like, are they more resilient when their shock comes out? This requires for a large scale perception survey where you go out and talk to people, run these surveys, and it should not be something that we expect to see only once, but over the years, as their savings build up and they are able to use these financial products in more and more optimal ways, are they able to face their future, whether it's in aspiration or in terms of resilience to adverse conditions? Are they able to do this better off compared with those people who do not? And this is what we call the input output outcome framework for financial inclusion measurement. And please note, in this, we are not pretending that, it's a very simple thing. It's very difficult. The complexity that we'll add here is that, and this is perhaps even more true for the global south as compared with what we see as individuals in the global north, that it's not just a person by themselves. it is about their entire household. It's about the family. No one in India stands alone. Stand within the construct of their family. So these are best measured at the level of households and families as compared with just individuals. Although you could do it for individuals, but there are increasingly studies that are going and starting to ask questions about how it is that people are financially included, not just being measured in terms of the number of accounts that they hold, but in terms of their confidence in facing the future.
Thank you for taking that large body of work and condensing it for us in such a simple and, makes it sound so obvious that you need to understand the outcomes. And on the, the point you were making in the end about the individual and the household, one of the things I've come to realize in the fieldwork that I've been doing a part of my Interledger project is there's also the third link to it, which is at the community level, specifically when you go into societies that are close knit. There is some kind of financial inclusion that can happen at the community level where households help each other out, even when they may not be individually at the household level, what we call quote unquote fully included. So that's been an interesting observation for me.
Yeah, so if I may just take one more minute of time, in the olden days, before there were banks and before there were insurance companies, I mean, certainly for all the people in India, and I know that there are studies that have documented this for households and communities in Africa, there used to be these things where there was community savings and lending. And in India, they are called chit funds. In various countries in Africa, they were called Roscas. And this was a community effort that there was a promise that was made by a bunch of people in a community that every month they would pool together some funds and the family that was most needy would get it, right? But this was a promise. All those families had to come once a month and put in their share into a pot, and only one family could get it. And this would only work if there was sufficient trust in the community, which is something which is critical for such long term promises to hold.
I'm going to turn to you, James, on this theme of outcomes, talking about fundamental change, some of these things that Susan brought up. I think it goes very intrinsically to the questions of, behavioral factors. So can you tell us a bit more about this fascinating field that you're a part of behavioral sciences, and what lessons does that seem to hold for furthering financial inclusion? Would love to hear about, your work, both in terms of the kind of interventions that have been adopted and what are the outcomes that you've seen in your work?
Thank you. And I think before I answer that question, I just want to support what Susan has been mentioning because I couldn't agree more. And I think essentially what she's been saying is part of the reason why we're seeing a change of taxonomy from financial inclusion to inclusive finance is that we're now trying to see if we can ask better questions and think about where we go from here. So we're at this sort of working point where we're thinking a lot more deeply about livelihood outcomes. So what is a financial life? Like what are the different components of a financial life? And how can these policies and programs and products actually help improve livelihood outcomes and improve the financial life aspects of what we're trying to do? And when it comes to financial inclusion, don't get me wrong, the progress has been great and it's been significant. But the question is, how do we leverage these gains? People are aggregating in both analog and digital settings, but how do we leverage the momentum that others and the industry itself has been creating to build something else on top of that and to really think about what are the lively outcomes that we aspire to create for people in the global south? So to go directly into your question, Smriti, is the behavioral factors when it comes to financial inclusion. And obviously, as Bisara, this is our bread and butter, and this is the problem that we usually try and tackle. The first is surprisingly simple, and it's essentially the biggest problem that we often encounter with different partners that we work with is the lack of relevance and clarity of value propositions. And so where we come in is our behavioral lens help us understand if financial products truly fit people's needs. And more importantly, it helps us understand why, which is the mechanisms. So once we understand how and why people prefer certain ways to transact, to borrow and to save, and I like the example that Susan gave around the savings groups, and here they call rosters, but you also have circles and other analog grouping mechanisms, is to really understand why do people prefer these. Our ability to listen and to understand those preferences and to anticipate what is likely to change and what is not likely to change is essentially how we're able to influence behaviors. And I should also say to positively influence behaviors, because obviously the application of behavioral economics needs to be done responsibly in a way that's aligned to people's own beliefs and people's own aspirations. Second, I would say it's incentives. So especially when it comes to financial inclusion, not always, but sometimes there's an expectation of formalization or digitization, which is great. Digital is an effective tool, it's efficient, but it's not necessarily an outcome. So what we often encounter is asking our partners to really consider what is the incentive for people to switch from the trusted analog method to digital ones. So why switch from your savings group and from borrowing from your friends and family to switching to an app or some other similar form of mechanism? So one of the ways in which we approach this problem is through testing. So to really understand for this value proposition, to what extent does it resonate with them? To what extent do they trust it? To what extent is it similar or dissimilar to the existing mechanisms and the existing ways that they prefer to approach finance, be it a transaction, be it a way of saving, or be it a way to borrow? And the reality is people will always stick to what works for them, and as they should. So any effort for digitization or even policy should align to people's needs and preferences if we're truly trying to drive meaningful change. Another is the complexity of financial decision making. So here we have the behavioral biases, that I'm sure many of us have heard about. And this in particular comes into play when you think about aspects like saving behavior or investing in long-term financial products. And this is where the nuances of psychology become more important. Because, for example, in the informal sectors that are very common and represent a majority of the economies in the global south is how do you introduce a concept like a pension to make it something that's more urgent and also realistic, because you also have to think about scarcity of resources for people to put money away for the long-term futures, for retirement. And so understanding these biases allows for the design of financial products that align with real-world decision-making, making it easier for people to engage. And so you come with this, again, global north concept with its own definitions, with its own taxonomy, and how can you change that and apply it to the local context? And we're not just saying sub-Saharan Africa, but we're talking about whether it's Kenya or Malawi. How can we create a program or an initiative that aligns to better with existing ways of transacting such that they can better engage with a concept like putting money away for the long-term futures? And lastly, I would say it's customization. And again, it goes back to this principle that context matters. Context always matter. And by using behavioral insights, financial services can be tailored to meet specific needs and contexts of different groups. And where we're seeing this becoming more and more prominent is women. As we know, there's huge gender gaps that exist in finance, in traditional finance, in particular when it comes to banking and other forms of financial services. But the reality is some of these gaps are transcending also into digital spaces. We're seeing a gender gap in access and usage of digital financial services. So thinking about how can we create financial products and services, and how can we implement programs that are able to close this gender gap in access to finance and access to markets and access to trade. And so we're really thinking with our partners about what are the unique needs of women, what are the realities that they face, what are the existing ways that they prefer to engage with finance, and how can we build effective markets and products that better align with them. And so, without going further, I think I'll leave it at that, but thank you for that question.
Thank you. That was fascinating, and thanks for breaking that down. I was interested, you talked about pension as one example. Could we go a little bit deeper into that? I would love to know, what are the kind of barriers behaviorally that you see in terms of trying to convince people about the benefits of, long-term or old age savings, and what is the kind of intervention that is needed to then change their mind? Like, is there any kind of example in that space?
So I can give an example that one of my colleagues is currently working on. So thinking about the concept of risk management, and especially in group settings, is that sometimes when you introduce a product and you call it insurance, it's a different context, but essentially what it means, it's a risk adaptation mechanism. And often what exists already in these markets is people have root mechanisms of ways to deal with risk. So I've heard these examples about, every month a different person contributes money to this pool, and at that point everyone withdraws. So there's different forms and variation that takes, but essentially it's people recognizing their susceptibility to shocks in their own environment, be it climate, be it enterprise, and especially with COVID, we've seen the importance of building resilience. And so essentially it's thinking about, from a program perspective and from a private sector product perspective, is how can these group mechanisms be optimized such that you create efficiencies in the way that people transact with each other, and think about the incentives for increasing, for example, the savings behavior. So can we nudge people towards increasing their savings amounts and complying with their own set objectives for how often they make these contributions into this pot, such that we create a more robust environment that people can benefit from each other. So rather than coming with an alien concept like insurance, as much as insurance is very necessary, especially in the context of emerging risks associated with climate change. But how can we leverage the existing groups and think about how we can bundle different products together and optimize already existing processes to arrive at the same objective rather than coming with our own predisposed notions about what works and the mechanisms that work, as much as they are true because we've seen the impact in different spaces. But how can we help people transition towards their own ways of adapting to risk, their own ways of understanding and predicting these risks in a way that works for them, and instead of us trying to, in a way, force people to behave and participate in markets in a way that we assume they should.
Thank you. Thanks so much, James. I think that's an interesting, point of departure from you're talking from risk management to another kind of product, which I know both of you have studied in different ways, which is digital credit. And I think that's an interesting product to talk about in the context of financial inclusion or financial well-being, because unlike certain products like insurance or bank accounts or payments even, there is a more tricky relationship with the credit and financial well-being because of the potential of overuse and people getting caught in debt traps. So maybe I'll start with you, Susan. Can you tell us a little bit about your work in this space, and more broadly your understanding of what could be responsible digital credit, given these challenges of the potential debt traps, etc.?
So when we think about debt traps, I think that what we usually think about is over indebtedness, that there is an individual or a set of individuals within a family, all of whom are able to get credit. I think digital credit is understood today as a phenomenon where, as opposed to the old traditional process of going to a bank and doing a lot of due diligence and going through a laborious process to validate your ability to repay, today digital credit is typically targeted towards much smaller loan amounts. And then, depending upon your instant behavior, you get access to a lot. I think that it has been overhyped in a certain sense because by its very definition, because the extent of time that the traditional credit models spend in doing due diligence does not show up in the digital credit space, most people think that that credit is easy to access. I mean, my observation is that that's not true. It's not the same credit product. They are much smaller in size, so that if a person does not repay, the lender does not face a crisis, which typically happens when you have concentrated loan amounts. So I think that the very nature of digital credit enables better risk management for the person who is making the loan. And if they find that on small payments, one person is not able to repay, they will simply not issue the fresh credit amount. So I think that there are some benefits. And of course, because it's being made instantly accessible to the person in need, these are typically products which are small in amount as well as short term. Where I think that it can become irresponsible is if you are lending these things to many people in the same household, and the same household is going into distress, and that there is no information sharing about the extent to which a household is overextended, as opposed to just focusing on whether the individual is overextended. But this is all about the business practices of the lender themselves. And I think that it is something that is interesting, it is evolving, and my suspicion is that there should be more of this because the nature of the global south is that households are small, they don't have that many assets, but they do have requirement of short-term credit requirements, the equivalent of a working capital for companies. And this is a model that needs to evolve its own risk practices before it can be considered to be responsible or dangerous. I think that the problem might be that the same kind of biases that we see in the large credit business models. And this is a well documented phenomenon that women, even though they end up doing extremely good repayments, because they don't have ownership of assets that is their own, as opposed to the family owning assets, women tend to be seeing a bias in terms of being able to access credit on some of these platforms as compared to the others. But overall, when we did our studies and asking whether digital credit platforms are giving a higher sense of resilience and comfort about their future to various families or to various people who are using these digital credit platforms, we found that over and above all the assets that they hold or the income levels, so some of these households are richer as compared to the other, those who are able to access finance through these digital platforms tend to be a lot more comfortable about their ability to withstand shocks in the future as compared with not. So if we make this link between the outcome of access to credit or access to finance is supposed to be giving the individual or the household better comfort about how they can face the future, it seems that the early evidence says that these are all helping as compared with not. So that's what I would like to say. And as for the potential for overuse or indebtedness, I think it is in the incentives of the lenders who are able to set up the due diligence or the information share to do better risk management. But if we are focused on the individuals who are getting it, my sense is that this is a step in the positive direction for financial inclusion.
Thank you. That's an interesting perspective. James, I know you've also done work around, comparing the digital credit landscape across different countries. Tell us a bit more about that, please. And also whether you looked at only individuals and households as your unit of analysis, or were you also looking at small businesses? So over to you, James.
So I'll begin by saying when it comes to our perspective on digital credit, is number one is the do no harm principle. And so it sounds very simple, but it exists for a reason. So we need to be mindful of models and think about policy interventions for forms of credit that can create harm because we know that they can. And I'll give an example for some other work that we've done here in Sub-Saharan Africa, in an East African market, is by examining transaction level data from all mobile money credit providers, we realized that there was a practice of lenders extending digital credit loans to novice borrowers as a way of screening them. So essentially, you're giving someone a loan as a way to see who's eventually going to be creditworthy. And the byproduct of that is we have these borrowers who are newly financially included in mobile money and by extension digital credit, and they don't understand the consequences for defaulting on these loans. So what ends up happening is for some of these individuals, as soon as they're included in digital financial ecosystems, they're excluded not because they had any intentions to defraud, but they simply didn't understand the consequences and the terms and conditions of these loans. Of these loans. Also, some of the practices that we've seen are in debt collection that are particularly concerning. Is some lenders in the market, they often outsource debt collection practices to other third-party providers, and we're seeing scrupulous ways of calling people and threatening them, and I'll call you mother, I'll call you auntie, and all these things. And we're seeing some of these aspects that are bordering on fraudulent ways to pressure people into repaying the loans. And yes, there needs to be a sustainability of these markets. There needs to be debt collection, but thinking about how policy can protect people from some of these very left field practices. And finally, I think which is most important is zero interest rates. So some of these interest rates are extremely high, and I know it's problematic to convert the rates into APR, but ultimately we're thinking about hot state borrowers who have urgent needs. They don't really have a cool down period, and they take out a loan not fully understanding how much that it is that they have to repay and how much that takes away from the business or from their household, and the future implications of taking out that loan. Now, what that being said, around the do no harm principle is also thinking about what people want. And ultimately, people want credit, and I can even argue that people need credit, especially micro enterprises. And like you correctly mentioned, Smriti, we have done multiple studies looking at the role of digital credit for micro enterprises. And so, because of some of the emerging concerns around the growth of digital credit, there's been some conversations in some circles, obviously not all, to stifle the growth of digital credit. But I think ultimately, and this is something that I've also considered in myself, given the different points of research and the different kinds of data that we've seen, But also, what I see more of is people want more credit. People want more credit to be able to survive household shocks. People want more credit to be able to help with their liquidity needs for their businesses and, in some cases, to help grow their businesses. And so, for me, what this means is the industry needs to think about how to create an enabling environment for quality credit to exist and for it to thrive. And what do you mean by quality credit? I think I would put it in the three or four easy buckets. Is one is affordability. So, is there a way in which the risk that the lenders are exposed to can be reduced? So, we're thinking about credit reference bureaus and other mechanisms by which the risk exposure is lower, and hopefully, hypothetically, that can drive down interest rates. Second is amount, and this matters a lot, especially for entrepreneurial use cases. Is when you have a loan for your business that can help you get an asset, whether it's a fridge for your little shop or whether it's some kind of labor saving device or some kind of agricultural machinery for you to be a more productive farmer. When we're able to create an environment where there's higher credit limits or people have a better ability to grow the credit limits over time, is where you can get towards purpose driven lending rather than the more generic consumer loans that we're seeing as more prevalent in the market. And then similarly for entrepreneurs is the tenure. So when people take out these loans, when the due date comes before you've fully realized the impact of that loan. So, for example, if it's some kind of asset, before you're able to actually get the increased revenue from having that asset, and if the loan comes before then that becomes problematic for your business. So, how can we support the establishment of business models that are responsible, but then also think about the supply side mechanism in terms of what's sustainable? How can we reduce the risk exposure of the providers such that it creates a strong business case for the supplier of the loans, but then also supports people at a household level, for them to be able to adapt to shocks, for them to be able to get access to education, for them to, and also for enterprises to grow their businesses, to expand their businesses and create employment.
I think that's a fascinating point, James. I think we don't think often enough about financial inclusion as being a two-party system, right? That we often think about the individual, we think about the household. We don't often converse in the same story as the lenders. The lenders are playing a role, and it is also important to think about the kind of risk that they face. And the one addition that I would make to the narrative that you just presented is that, in a certain sense, we think about the small households and the small individuals who are taking these loans in order to support an enterprise, particularly when these are the lower income households that we tend to see a larger fraction of in the global south. They have less of the support system or the wherewithal to buy or access risk management tools. But what is more interesting is that if there is a lender who has given a large number of loans or even a small number of loans to a set of farmer entrepreneurs, and the farmer entrepreneurs are saying that it is going to take a little longer for them to repay on those loans, it is actually something that is a risk that the lender themselves can take hedges against or protect themselves against, as compared with the farmer or the individuals themselves. So I just wanted to emphasize that it is important when we're thinking about a sustainable, and you brought the phrase responsible digital credit, but I think I liked James' point that people want credit, they need credit. So we always need to have a supply side where people are willing to provide the credit. And the only point that I will add to what James said is that the lenders are better able to protect themselves against the kind of shocks that even the small farmers and the households are going to withstand. And that is something that we should put into our equation when we think about developing sustainable digital credit or credit markets.
Just to broaden this conversation, we've been talking about financial inclusion, we've spoken about specific products, but to look at this under the broader umbrella of the financial regulatory landscape, and we know within that inclusion is one agenda, but there are others like consumer protection, like data protection. and privacy of consumers. So just to understand, like, one of the ways this is linked is, just drawing from the comments that both of you made, is this idea of creating credit registries, saying that, we don't have data about credit history of some of the small businesses. So there is a conversation, at least in India, about, being able to take data at the individual level of these proprietors and trying to use that as a basis for giving them credit. And that, of course, brings up some questions around consumer protection, around data privacy. And another example which comes to mind is from the payment space, where, we are seeing this push towards frictionless instant payments, and the emphasis being on frictionless, where sometimes this is coming at the cost of increase in the amount of frauds, of people not understanding the swiftness with which the transaction is taking place. So I want to come to both of you, maybe starting with you, Susan, on, do you feel that the agenda and the work on financial inclusion that has been going on has kept pace with the other broader regulatory developments that we need for this to become like a whole financial wellness package, so to speak, for the consumer?
I mean, simple answer, I think no, because the rate of growth of financial inclusion has been really rapid. I think that there was a lot of nice work that was done in about 2013, where we thought about building a consolidated policy framework for finance. I think, Smriti, you may remember this well, but this was the Justice Sri Krishna Committee, the FSLRC, the Financial Sector Legislative Reforms
Mhm.
Commission. And one of the big thrusts in that was to worry a lot more about financial consumer protection. I think that it is a challenge to the existing large financial service providers on how to provide good consumer protection. And if you start consumer protection as saying, we don't know how things are going to go bad, then the first stop is to be able to collect consumer grievances and to set up a consumer grievance redress mechanism. And my suspicion is that even for the existing financial service providers, that is something that we, at least in India, across the different financial service providers, are still working on developing a robust system for.
Mhm.
So, beyond what you said, as if we just focus on digital credit or credit as a product, it is, yes, I agree, important for us to have in place good information systems about who are the defaulters, what is the information about the loan size that they're defaulting on. I would take a step back and address the larger question of the approach that we as a country has taken to financial consumer redress, because that's a point at which you understand or you have a feedback mechanism from the users of finance into the regulatory space. Because I think one of the things that we have seen very often is that there are a set of harms that we observed in other countries, and we presume that those harms will happen in our country or in the global south, the same kind of harms as we see in the global north. But to James's point, right? Nothing about these need be the same, because they are a very different set of people and types of people, their desires, their wants. They can be similar, but the levels at which they exist are completely different. So, my sense is that we have captured or we have put in place consumer protection, which is similar to what we see in the global north. But perhaps there needs to be innovation on that front as well. So, I agree with you that we do need to worry about consumer protection when it comes to data and data sharing. But I think that this is one piece of the puzzle when we think about financial consumer protection, because ultimately it's about asking whether your customers have faith in the system when they put aside their savings into financial products. Financial products are tricky, right? It's not like buying a refrigerator. You are putting money into a product which will only give you returns over a very long horizon. It can be short term, it can be medium term, it can be long term, but you need to have the faith. And so it is critical for us to put in place consumer redress where grievances go back to the regulator and they see the regulators are taking action. So I would worry about that not being fully understood and put in place in India.
Right. Thank you. Thanks, Susan. James, I'm going to come to you with, 2 points. One, on anything you want to add in terms of the consumer protection framework in the African context, which, you might want to add to what Susan was saying. And the other is, Susan mentioned something about, the that the harms from one context will not necessarily translate to other. We spoke about how, regulatory factors, regulatory features may not translate, but are there positive lessons which actually could be translated from one country context to other? Is there anything in Busara's global work that you have seen where you feel that there are some interesting cross country linkages that can be made?
Thank you, Smriti, for that question. So, to respond to that, I'll first start with that example. So, I remember reading an article a few years ago from the former governor of Kenya Central Bank, and essentially he was saying that the number of issues that come to his table when it comes to consumer protection in the digital credit environment take up so much of his time. And yet, in the context of the larger scheme of things, when it comes to the overall credit market, the digital credit environment represents about 10% of the overall borrowing economy. And so I think what this speaks to is the stage of the environment. And a lot of digital credit markets, especially in Sub-Saharan Africa, are at an embryonic stage. They're still early. There's still a lot of innovation. There's new entrants, and there's also new borrowers. And what this leads to is undesirable outcomes, both at the borrower level, but also at the supplier level. But again, we go back to the principle of impact first priority and consumer protection first priority of do no harm. The role of the regulator is to ensure that the borrowers who are in the millions are protected from variations of digital credit, intentionally or not, that create less than desirable outcomes for customers. But also, an important principle here is to think about the regulator capacities. And so different regulators in different markets have different regulatory capacities, be it technology, be it oversight based on the different constitutions to actually implement and protect customers from these laws. And so regulators themselves are having to innovate, they're having to update how they view the markets, and they're having to update how they think about their legislative oversight to protect customers. And I think the development space at large has caught up with this dynamic and thinking about how can we create sandboxes, for example, where a provider can come and they can figure out, they can test it in a controlled environment, and we are able to anticipate some of these negative consequences before they're actually scaled into the market. And so I guess I would say that's one of the aspects that's transferred well from other markets, although we've not directly been involved with them, but they do feature in our research, is seeing how we can create sort of these testing environments that sometimes we do or like on our own. But not only in credit, using our lab apparatus, we have different mechanisms for testing people's ability to understand terms and conditions, for example. And what we see is that we have a lot of assumptions around people's, especially now that we're speaking extensively about digital credit, we often have a lot of assumptions about people's ability to understand and compare information and to make decisions that are consistent with their own priorities for their own well-being. And so, for example, thinking about how people are able to compare terms and conditions from the interest rate to the tenure from one provider of a kind of loan to another. And from some of the research that we've done, that's also been applied to different regulatory contexts, is that people often struggle to make calculations because of information asymmetry, for example. So in one provider, the information is simple, the other one is complex, and people's ability to compare financial products leads to their lack of ability to compare financial products leads to their inability to switch and their inability to have behavior that makes them choose a cheaper option or an option that's more optimal for their entrepreneurial activity, for example. And that also has negative consequences at a market level. So maybe you have legacy providers that are able to keep the customers captive because they don't really understand what else is available in the market. They're not able to compare, and they're not able to find another deal elsewhere besides the first provider. And so those are some of the nuances that we're seeing, that from a regulatory perspective, the power of information or the power of quality information can help customers behave in a way that's consistent with what they want, but also has positive outcomes for the market at large, particularly when it comes to competition that can drive down prices and have other positive impacts as well.
Thanks, James. Yeah, I think that's a really critical point on the role of competition and the effectiveness of the market as an intervention in furthering the inclusion agenda. So we're about to close our conversation, and before we end, since both of you have been so good, I'm going to hand each of you a magic clamp with a genie. which is going to let you envision what you see as the future of digital financial inclusion. So, starting with you, Susan, maybe can you tell us what are the kind of outcomes that you expect to see in the future of digital finance, and what do you think are the steps that will take us there?
So, all our research work on understanding financial inclusion, the entire chain through input to output to outcome, leads us to believe that the more access to finance, people will get better off, right? Irrespective of how rich they are, poor they are. Financial access does matter. It's not the only thing that matters, but it certainly has a non-zero significant effect. What is the future? I think that all stands in the hands of the environment, of regulation, because I do agree with James, right? I think that when people see their neighbors who have access to finance being better off, they tend to learn through that process as well. I agree with James that regulators and policymakers do play an important role in doing the learning, allowing or facilitating for people to learn faster, to understand better, to get better clarity. I remember that our securities markets regulator has made lots of changes on how information about products should be more clear in larger font and the like. But it does say that if we want to go down the path of digital financial inclusion, there needs to be a lot more innovation that is permitted in the space before we can get those links between people and the financial products done. How does that pan out? I think that it's all positive, but the question that comes to my mind when I think about the global south are who are the people who are going to take the business risk in terms of building these models, because there is still a lot of work to be done.
Thanks, Susan. James, your wishes and what it takes to get there?
For me, again, I want to agree 100% with what Susan mentioned, is that there's still a lot of work to be done. And how I often think of this is a pyramid. And so when it comes to inclusion, I think there's a lot of questions that are being asked for good reason about the livelihood outcomes associated with inclusion. But also, I do believe that those gains shouldn't be watered down, because it's a foundation upon which other things can be built upon. So at the base of this pyramid, you have inclusion. So getting the masses into formal or informal financial systems, that they have options of different ways to transact. They have options of different ways to save, different ways to borrow. Now, what comes beyond that is usage. So thinking about how not only are we giving these people access, you get them an ID, you get them an account, or you get them like a mobile phone, but getting them to actually use these products in a way that is convenient for them, in a way that helps them get other tertiary benefits that would come after. And so naturally, at the pinnacle of this pyramid, I would say that that's where the value addition is. And so this is, like Susan said, where it's a more difficult question, but I do believe it's very surmountable. So how do these different initiatives, how do these different products actually add value to people's financial life? How do they increase household resilience? And how do they help enterprises grow and create more jobs, is where a lot of the financial inclusion industry is looking at, is like that value creation pinnacle. But then also, like I mentioned before, is the diversity of the different contexts in sub-Saharan Africa, for example. Some markets need more attention to the inclusion stage. Some markets, like in Kenya, need more attention to the value addition stage, where we've seen people aggregated because of aspects like mobile money. There's data available, but what do we do with that data? How can we actually optimize the financial lives of people who are using these products and have been using them for years? And I think that's the pinnacle that my team and I in particular are really excited about working with our partners on.
Thank you. Thanks so much, James. And I think that's interesting. We seem to have come a full circle, because the peak of your pyramid really points back to the outcomes limb of what Susan has been explaining from her work. And so we all seem to be kind of on the same page of understanding the importance of outcomes in this whole conversation. The key learning for me has been that, you just don't need good intentions or good policies or a good financial product to actually get to the finishing line on terms of outcomes. You need a lot more. And hopefully, for everyone who's been listening, we've managed to bring out the importance of interdisciplinary work in this space, and the role that the research community, which all of us here are a part of, has been playing in our own ways to deepen the understanding of financial inclusion and kind of help the ecosystem assess how we are faring in terms of measurable outcomes. So, with that, I'm going to thank you once again, Susan and James, for this rich and insightful conversation, and to the Interledger Foundation for inviting us to this episode of The Salon. Thank you. Have a good day.
Thank you.
That's all for today's episode. To learn more about Smriti Persera's research and her ambassadorship, please follow the link provided in the episode's description. We hope you continue to enjoy our discussion on digital financial inclusion and its global impact. Thank you for listening to the third iteration of the Interledger Salon.